For UK stocks I'm buying, January 2024 edition. This is where I go through the UK stocks that I'm buying through the 1st of December to the 1st of January, and it just keeps with that transparency so you guys know what I'm buying and what stocks I'm selling. I don't sell something quietly out in the background like other YouTube channels and pretend it never happened, and as well as that, I don't hide any stocks I'm buying and all of a sudden pop up and go, oh look, I bought this stock 2 years ago, look how much it's up, I'm a genius. If I did buy it, you'll know about it on this video. Now, there was no sells that I did during this time frame, so there were no stocks that I sold, but these are the 4 UK stocks that I were buying, so hopefully this video helps you guys, and let's get started. And as always, if you want to know what I'm buying and selling in real time, the place to be is on the Patreon. You join through there, it's only £5 a month, you get to know what I'm buying and selling in real time on there, and you get 2 exclusive videos a week. So we'll be doing one over the weekend, which is a stock request, and as well as that, there's a Discord with members to talk to about stocks. In my opinion, the best Discord out there for the stock market, and as well as that, that's the best place to message me if you want to get in contact with me. If you do want some free shares, join Trading2 with link in description, get a free share worth up to £100. That's personally the broker that I use, and I think it's the best broker out there. But let's get on to these 4 UK stocks. Number 1, Card Factory. I have been buying more shares in Card Factory. I know I am averaging up big time. I first started buying this stock 3 years ago in 2020. Prior to 2020, the company was mismanaged big time. They were taking on big, massive debts. They weren't managing the profitability. They were paying a dividend they could not afford out, and that caused the share price to go massively down. Since then, the CV situation actually helped them. They were able to have a reason to cancel the dividend. They brought in a new management team, and the company has been turning around massive since that time frame. Now, even though I could hold my shares from 2020 and I would be up over 187% on my shares, I don't. I keep buying more and more, and I average up on this position because what's more important to me is not going, oh look, I'm up 187% on the position. I want to make more money on this company, and I keep looking at, even though the shares are going up and up and up, I don't think they're reflecting it enough for the progress that this business has made. And an example of that is they're currently trading at 6 times earnings, and this is the best place this business has been in for many years. And in fact, the financials are brilliant. A lot of businesses would want to have Card Factory's financials. Now, the company itself obviously has the online site, but the big thing is the stores. A lot of people go to the stores, especially right now when people are being a little bit more conservative on the money, rather than going to something like Moonpig, for example, and to pay for a card on there is very expensive. People are going to get these 99p cards and saving themselves a lot of money, and it shows you there's still a lot of room for businesses like Card Factory. Now, they are supposed to bring out a trading update in the next coming weeks, so this information can go out of date very quickly because we'll get the most important period for them, which is the Christmas period. But what we had from the latest information was really good. So they actually came out with a trading update in August, and they said that there has been a positive start to the financial period, and they are trading for the first 6 months was materially ahead of the board's expectations. And they've done this often. They've come out and said that we're trading ahead of expectations, and then we had the interim results that came out on the 26th of September. And if you look at those results, they had group revenue up 11.5%. That's absolutely amazing. So many companies wish they could grow at them sort of levels. Like-for-like sales up 10%. Positive progress in partnerships with revenue of 6.4 million, including a 23.5% increase from existing partnerships. And that's something that the company's really been working on. They've been trying to open up new stores in new locations. They've been making partnerships with the likes of Masland, for example. So that's another way that they've been trying to increase the footprint to gain more sales, which seems to be doing very well. And if you look at the other numbers as well, EBITDA was up 16%, profit before tax was up 72%, net debt as well was down to 71 million from 96 million, which once we talk about again is the balance sheet was ugly prior to 2020, and now the balance sheet is starting to look in a very good position as well. And basic EPS as well was up 64%. Now, like I said, we are due a trading update. We normally get one before the Christmas period, which we didn't get this time, which I think is why there's a bit of nerves going on with the stock at the moment, and it hasn't really moved anywhere, even though the company's been trading ahead of expectations for most of 2023. I mean, it is still up 27%, which is still pretty impressive, but maybe it should be up a little bit more when you look at the financials and look at the valuation at 6 times earnings. And maybe because there's not been that kind of trading update, people are a little bit nervous about, oh, well, there should have been a trading update in November, and that hasn't happened. But like I said, we are expecting a trading update in the next week. So you can see here last year on the 10th of January, they did post a trading update historically, so we'll see if that happens again. But the company should continue to ramp up profitability and revenue. Obviously, they've got the higher tax bracket to pay for, which is just a short-term charge that's currently nothing that's surprising that's going to happen, that's going to cause a little bit of a dip in the profitability. But apart from that, the revenue and profit growth should continue to be really strong. Financial health-wise, the balance sheet has majorly improved. Even right now, Simply Wall Street, that is the platform that I'm using, is a little bit outdated on the actual financial information. And by the way, if you do want to get access to Simply Wall Street, there's a link in the description which I think gives you 40% off a yearly subscription. Obviously, you guys see that I use this a lot in my videos. But you can see here the debt is suggesting it's 98 million. Like I just showed you, it's actually dropped down to the 70s. So the debt position is getting even better, stronger balance sheet as well, a decent amount of cash as well. And as well as that, around June time, the new CEO, Darcy Wilson, which has done a fantastic job at Card Factory, he was actually buying around about 80k worth of shares at 91p. Now, if you do look at the current share price, it's a little bit above what he was buying back in June time. So you're very close to where the CEO actually bought a ton of shares as well. And obviously he was buying it because he was seeing how good the financials were. So Card Factory is definitely one I like. I think you can even slap on 12 times earnings and it still looks relatively cheap for the financials they're doing. So yeah, I like Card Factory. And in fact, me making this video right now makes me think, should I be probably buying a few more shares in this? Because I've not actually bought so far this month yet. We'll see what happens there. The next one is Money Supermarket. So this is a stock that I keep buying, even though I want it to go lower. So I'm sure most of you guys are aware, I started buying this stock around about £2.20, £2.30, and originally I was like, I want it to go back into the £1 range. It never happens. It keeps going up a little bit more and more and more. So I keep averaging up. I'm waiting for the big drop into that £1 range is where I like it. But until that happens, I'm going to make sure I have a decent position, and then if it does drop in the £1 range, I'll probably try double up on it. But 19 times earnings, which isn't too bad, but when you look at the profitability ramp up, that earnings is going to drop very quickly in the next few months and years. Dividend yield as well does pay a 4.35% dividend. I should have probably mentioned on the Card Factory one as well, by the way. They're probably going to bring a dividend back next year as well, which will be around about, I'm guessing around about a 3% dividend yield as well, which will be really nice. They've just got a few bits of debt they have to pay off that's in the contract before they can pay the dividend, so that will be resolved in next year, so that probably will come back. But getting back onto Money Supermarket anyway, yeah, you're going to get a 4% dividend yield here, 19 times earnings. Obviously, comparison website, a lot of comparisons: car insurance, home insurance, broadband, travel, pet insurance, mobile. There's a lot of comparison sites, and once again, what we're seeing at the moment, everyone's being a bit more conservative with the money, trying to save as much money as possible, going to comparison sites and saving money. And the thing as well is, when one category does very well, it makes up for maybe a category that doesn't do well. So you'll see times where insurance might be weak, that's made up by travel insurance. Travel insurance goes weak, that's made up by home insurance. So because they are exposed to so many markets, it covers times of weakness as well. Now, if you look at the recent results, I thought they were pretty good. If you look at the categories: insurance, money, home services, travel, cashback, you'll see here that there was the growing categories of insurance. We've seen that with the likes of Aviva and Legal & General. There's been a lot of insurance increases because of inflation, and a lot of people are trying to compare insurances at the moment. And you have the likes of home services, which is struggling at the moment, and a lot of that is to do with the energy price cap situation. That actually, if you go back to the financials they were doing before that whole situation, that has a lot of potential to recover in the next few years, which I'm personally investing in for. But if you do look at the financials, they do throw off good amounts of profitability, as you can see here. The company should grow around about 10% a year, which is about historically what they do. Big thing is that energy comparison site to come back on. If they get back to that point of view where the energy market comes back online a lot more aggressive, that's where they'll do very well. If you actually look at what they were doing previously before the whole energy situation, and then obviously they had the CV situation, so that messed up the travel insurance as well. Money Supermarket was actually doing 94 million in profit, and they had a 24% profit margin. So there's a lot more expansion on the earnings basis and also on the profit margins that they can do, and I expect that to recover. That's what's going to push them actually back over to about 100 million in profitability, which then makes it look not too bad. Financial health wise as well, it's a very good balance sheet. They do have a little bit of debt on there from some acquisitions, but yeah, I mean, it's 63 million in debt, and we expect them to, in the next 2 years, to go up to 100 million profitability. So they'll be able to pay that off with a year's amount of profit if they wanted to. So not much issue there. Dividend as well, it's got a good track history of growing dividend as the profitability goes up. And there was some insider buying. It's just gone off now because it was just over 12 months ago. There was a lot of insiders buying in the company at the back end of 2022. Obviously there's a buy here, but it's only a small amount. So that was also a really big positive, and they were all buying in the £2 range. So yeah, I really like that. And the third stock is Supreme. So I am a big fan of Supreme. I think it's a bit like a card factory. Really good financials. I don't think the valuation is baking it in at all. 8 times earnings, 3% dividend yield as well on the business. Now the company has 4 categories. It's got vaping, lighting, batteries, and health and wellness. Obviously, let's talk about the elephant in the room, vaping. So the big thing about Supreme is people put it down at a lower valuation because of the vaping exposure they have. Half the business, I think it might even be a little bit more than half the business comes from vaping. Now obviously we know there's a lot of talk about vaping and maybe the crackdown on it potentially, and yeah, there could be some going forward. Now the big thing is that vaping is still going to be healthier than smoking. As long as there's this alternative here and smoking is still allowed, I think there won't be too much crackdown on vaping. Now there might be some sort of regulation, maybe taxes put on it a little bit more. That's granted, but when you look at the government and they're still trying to push, smokers towards vaping, I think vaping is still going to exist even with the crackdown on it. Now that might affect it a little bit, but I still think sales will be very strong. I think it's one of those things that people, even if you make it harder for people, even if you make it more expensive for people, they're still going to go do it. And granted that you have to bake in the risk that they have the exposure, and there's also the crackdown on vaping. Now ultimately what do? Well, you stick a lower valuation on it. So rather than saying this company is going to trade at 20 times earnings, because of the risk of vaping, you put it down at 15 times earnings, 14 times earnings, 30 times earnings. But ultimately, I think 8 is too cheap for this business. And as well as that, they are exposed to other industries. So even if something was to happen to this vaping part of the business, they've still got lighting, batteries, and health and wellness. And actually today, as recording this video, they have actually just made an acquisition to improve the distribution of their health and wellness business. So that shows that the company is trying to ramp up the other categories to protect themselves from the vaping business. I think some people forget that they have these other parts of the business inside the company. And when we look at the half year results that came out on the 28th of November, these were far ahead of expectations that the market was expecting. The company grew 63% year over year. Now I know that's something that they won't be able to keep up forever because they won a big partnership with Elf Bar. But even so, that's very, very impressive. And when you look at the other categories as well, lighting was up 21%, vaping 17%, sports and nutrition was up 17% as well. So these other categories are still supporting the business in a decent way. You look at the revenue, obviously we talked about how good that was. Adjusted EBITDA was up 88%, profit before tax was up 179%, and EPS was up 182%. Now, you can see on Simple Wall Street, they're currently saying that they think Supreme is 70% undervalued through their DCF. Obviously, they're not baking even in the cheaper valuation because of the risk of the vaping situation, but it shows you that even they think there's a lot of upside up here. And you can see the jump up because of the Elf Bar partnership that they have going on. Profitability should move up in a good direction going forward as well, and we should expect this company to grow a good couple of percent a year as well. Balance sheet wise, you've got a very good balance sheet with this business. They sit on 22% debt to equity. Obviously decent amounts of profitability as well. They could pay that debt off in a year if they wanted to. You've got the dividend that's going to be increasing as well. And from an ownership point of view, you actually had the CEO buy nearly 500k worth of shares at £1.28. So if you actually have a look at the share price today, you'd actually buy it lower than where the CEO bought 500k worth of shares not too long ago, which is pretty impressive. Yeah, there is the risk of the vaping situation here, but like I said, when you've got these numbers that the company's putting up, the dividend, the balance sheet, I think 8 times earnings prices in a fair amount of that risk. So yeah, once again, I'm looking at this one and talking about it a bit like Card Factory, and I'm thinking, I think I might need to buy a bit more of this after this video, but hey. Now moving on to the last one, which is number 4, which is Darktrace. So Darktrace is a company that always interested me. It IPO'd, the valuation went a little bit crazy during 2021, had a bit of a pullback through 2022, and then eventually it started getting into this £2 range, and I thought I'm going to buy some shares in this company. Since then, the stock rallied up, and I was sitting on, I think I was up 40% on my Darktrace position. Always wanted to buy more, never did, because I thought at £4 I'm not really willing to buy the shares at £4, and then recently we've seen the stock actually start going back into the £3 range. We might even see it go back into the £2 range. For me, that is where I would not mind buying some shares into Darktrace. Now Darktrace is a great addition into my portfolio because I don't really have too many UK growth stocks, and this definitely comes under the category of UK growth stocks. And as well as that, a technology stock, we don't have many technology stocks on the UK market as well. But the main reason why I bought it is because I wanted to have a cybersecurity play. Cybersecurity, I don't know about you guys, but you go on your emails every day and you're getting an email from every business going, oh, we've had a hack into our system, your password is at risk. I don't know if you ever do it, but there's like a password selection on like Apple, and it says, oh, this password's at risk of us because it's been in a cybersecurity attack. This one, you have like a 20 list of passwords that have been in cybersecurity hacks, and it just shows you like the cybersecurity market, there's just more and more going on. Maybe even because of the AI situation, there potentially could be even more hacks going forward, but this market is going to grow more and more every year. And you can see here that on this Yahoo Finance article, they're expecting a CAGR of 15.9% for the next few years. I think that you've got to have a cybersecurity play. If you don't, I think you've got to have an ETF. I bought Darktrace. The reason why is that it was a lot cheaper at the time of evaluation than a lot of other cybersecurity stocks. Now, to be fair, Fortinet has had a pullback in its valuation, and this one does look a little bit attractive on the US market. When you look at like CrowdStrike, for example, this stock never come, well, apart from 2022 when everything else was down. Even then, I thought the valuation was still like, whoa, it's a bit rich, but that was the first point I could justify paying for it, but at the time everything else was down as well. But this always trades at a rich valuation. But Darktrace always looked at the better valuation, and I don't know if that's just because it's a UK stock, and unfortunately they trade at a lot lower valuations. But yeah, I mean 89% gross margins, 46 times earnings. If you look at the growth of the business, very good growth. They've got to profitability now. Free cash flow, they're throwing off nearly 107 million in free cash flow. A little bit of a dip going on at the moment, but that should recover 150 million in free cash flow. I mean, if they can do that in the next coming year, that's going to put it down 15 times free cash flow, which I don't think is too bad. Financial health wise, it's got a clean balance sheet, which is really good. Sit on 358 million of cash. The only thing that I don't like is recently there has been some insider selling. So you can see here the CEO did sell a good amount of shares, and as well as that, the CSO also sold a good amount of shares. That's the only thing that I don't like, why they're selling at the moment when you think the shares would be low. I don't know if that's because obviously they IPO'd, and then there's the lockup period where you can't sell for 12 months. So when they probably would have been able to sell the shares, obviously they would have been around the £3 range. And then they thought, oh no, we're going to go higher from here, so we'll hold it. And then they went lower, and now they've seen the rebound. Maybe they went, you know what, we've had this stock on the public markets now for 2-3 years, and we've not been able to sell shares at a decent level, and now we've had a rebound. I want a bit of cash for something. That might be the reason why. That's the only thing that I don't like about Darktrace at the moment. But when you look at the growth on the recent update they did, revenue growth was 28%, and the forecast as well is for 22 to 23% this year. Adjusted EBITDA range of 17 to 19%, and a free cash flow range of 50 to 60%, which is still pretty attractive. And as well as that, when you look at Darktrace, it's going to drop somewhere between the 30 times forward earnings in the next year-ish. I think when you're looking at 30 forward times earnings, and you've got CrowdStrike that trades at 67 times forward earnings. Granted, it's got a couple more percent growth. The free cash flow is a little bit higher on the business, but I think there's a bit of a disconnect here. And overall, I just think there's going to be such a big market where they should do well, Darktrace. You know, in this market, they should be able to do very well, considering that, you know, the previous growth they've had here. So yeah, I did buy some more Darktrace anyway. So those are the 4 UK stocks for January 2024. Hope you enjoyed the video. If you could, hit the like button. If you're new around here and you found the video helpful, make sure you subscribe. Apart from that, I'll see you on Monday, unless you're on the Patreon. I'll see you on probably either tomorrow or Sunday for the video on there anyway. See you in a bit, guys.